Welcome back to Portfolio, everyone. And today we're going over the top 8 stocks you should watch this week. These are nice dividend and growth stocks that you could add to your portfolio, and all 8 of these companies report their latest earnings this week. And of course, when companies report their earnings, there may be some nice price volatility. Good or bad, could lead to nice buying opportunities for the companies. So the first 7 of these are solid companies that I believe will continue to grow along into the future. And that final 8th stock at the end of the video is a little bit more of a speculative play. Not really much of a solid company just yet, but it's in a growing industry that may seem some nice future growth. So I threw that one in there just at the end because it might have a nice buying opportunity sometime this week. So everyone, we're going to jump straight into the video. So we're going to go over the top 8 stocks you should watch this week. And as you know, I'm the Gen Z investor, and every single day on this channel, I come out with new videos that talk about different stocks you can buy, overall stock market performance, and any other big stock market news and headlines. So please like and subscribe, and we're going to jump right into the first pick. The first stock that reports earnings this week that I may lead to a nice buying opportunity is Clorox, ticker symbol CLX, currently around $236 a share. On the 1-year chart, you can see they have seen insane growth, up around 45% on the 1-year chart, and they are trading currently around their 52-week high. So this is a company that I believe their demand for their products will only continue to grow long into the future. So of course, we know Clorox provide cleaning products, and with how the world is today, everything has to be cleaned consistently every single day. And before, we didn't really live in a world where that kind of happened at the rate that it is right now. And I only believe that if this pandemic continues, this economic slowdown continues, these products are only going to continue to grow in demand because they provide some of the best cleaning products out there. They are one of the market leaders in that sector of the market. And I only believe that this company will continue to grow because I don't believe health and safety and cleaning standards are ever going to be declined anytime soon. And I believe all these businesses are going to have to maintain these high cleaning standards long into the future. So Clorox is a dividend-paying stock, and because they're trading all at their all-time high right now, hopefully they may see a little dip this week and may lead to a nice buying opportunity. Or if you believe this company is going to succeed long-term, then now may be a great time to buy with this earnings week coming up. With regard to their dividend, it's around a 1.88% yield, very sustainable payout ratio around 64%, a beautiful 5-year dividend growth rate around close to 7% on average over the past 5 years, and a 43-year dividend growth history. So they are a dividend aristocrat, and they're working towards becoming a dividend king. And with regard to their dividend, it is still safe with a dividend safety score of 75. So very unlikely that that dividend gets cut anytime soon. Moving on to the second stock to take a look at this week is Disney. So we all know Disney. We all know they had to shut down their theme parks, which bring in about a third of their revenue. We all know that it took a massive hit. You can see here on the 1-year chart, they are down 18%. Disney did suspend their semi-annual dividend payment. So right now in the 52-week range, it's trading somewhat in the middle. If you believe in Disney long-term, this may be a very interesting week for you because they did open their theme parks in this last quarter, of course at a reduced capacity. So it'll be interesting to see how they actually performed, if they actually were able to, bring up some revenues because of that little theme park openings, or how their other sources of revenue generated over this past quarter. So Disney is a company, of course, we all know everything they do, their streaming services, their theme parks, and they have a bunch of other, like their movies, they have so many other aspects of the business. So it'll be very interesting to see how Disney reports this week. If you believe in the company long term, I do not believe Disney is a brand that will be going anywhere anytime soon. It might be a nice buying opportunity with the shares down 18% this year. And of course, this week will be very interesting to see if we see a jump or a dip in shares. The third stock on this list this week is ticker symbol ATVI, Activision Blizzard. This is a video game sector company, which is in a sector that completely is growing at a very fast rate. Video game and esports is only on the upward trend, and this is a company that produces and sells video games in those sectors. They own some of the big names such as Call of Duty and World of Warcraft. You can see here they've seen an insane 1-year price chart up close to 70%, trading right at that 52-week high. So with this is a company that if they do report or they don't beat earnings or they show a little decline in revenue, whatever it may be, this may be a nice company to buy during a dip because of the growth in that video game sector and the fact that it's only on a strong upward trend. This may be a nice company to get into if there is a dip during this week. So that's another stock I like to watch. They do pay a dividend, very small at 0.5%, but their payout ratio is below 15% of earnings. So they are paying out almost nothing of their earnings per share, and they have a huge 5-year dividend growth rate of around 13% per year, and they have a 10-year dividend growth streak. If we take a look at the dividend, it is very safe. It actually has the highest dividend safety rating, so very unlikely that that dividend gets cut anytime soon. Moving on to the fourth stock on our list is Square, ticker symbol SQ. So this is the financial technology company. They create products to help different businesses do payment solutions and take and accept different Visa and credit card payments. So of course you've seen their products where they have those payment terminals for cards, and they also have those adapters that can go into iPads and iPhones where it's a card reader, so small businesses can actually collect digital payments. So that's the products they do. And of course, with the world we're transitioning right now, the financial tech world has seen a lot of growth, and I do believe Square has the infrastructure and the good products to actually grow with the growing sector. So this is another company you may want to take a look at this week who reports earnings, up 61% on the 1-year chart. Once again, trading at a 52-week high. So if you can see a dip this week, it might be a good time to buy in. This is a complete growth stock. They actually do not pay a dividend right now, but one day in the future that might be coming out. Moving on to the next stock. This one is more of a boring play. But of course, in a dividend growth portfolio, boring stocks are good stocks. You like companies who are not always in the news, not really making headlines, but are slowly growing year in and year out. And that is exactly what this company does. Ticker symbol AWR, American States Water Company, currently around $77 a share. 52-week range, you can see they are somewhat on the low side, which really caught my attention. 1 year, they're almost flat, only down less than 1% on the 1-year chart. If we take a look at the 5-year chart, they're up 100%. So a lot of share price appreciation over the past 5 years with regard to this company. Move over to the 10-year chart, they're up over 335%. So beautiful long-term price appreciation combined with a nice 1.74% dividend. And with the fact that this is trading on the low range of the 52-week high, it really caught my attention. It might be a nice addition this week. If we take a look at that dividend, currently yielding 1.74%, payout ratio around 59%, so below 60, very sustainable, a lot of room to continue to grow that dividend long into the future. Beautiful 5-year dividend growth rate close to 7%, with a 64-year dividend growth history. This company is a dividend king. They reached that 50-year milestone, and they've been doing it for 64 consecutive years of growing their dividend, which just shows that no matter what, through recessions, depressions, they can continue to pay out dividends to shareholders and actually grow that dividend each and every year, which is a nice stable holding for a nice portfolio. Moving on to their dividend safety score, they actually are at a 98. They have the second highest rating with a very safe dividend. So you can get into that 1.74% yields with that nice dividend growth. It is almost impossible that this company will cut their dividend anytime soon. Moving on to the next stock is actually a REIT. We have Realty Income Corp, one of the most popular REITs that a lot of people talk about, currently trading at $60 a share. 52-week range, they are closer on the low side than the high. You can see here on the 1-year chart, they are down 13%. So we all know this economic shutdown and this new stay-at-home economy has really shifted the way businesses own and operate their office space in different retail locations. And people are saying retail is dead. Offices are all going to be reduced in size. So it'll be very interesting to see how Realty Income actually performs into the future. But if you still believe in this company, you do believe they will continue to collect rent and grow the business, then it might be a nice buying opportunity this week. They are down 13% on the 1-year chart, but they are paying a beautiful 4.66% dividend yield. If we take a look at that dividend, current yield around 4.7%. 5-year dividend growth rate around 4.4%. So not the highest 5-year dividend growth, but your starting yield is high. So a little bit, you are getting your raise greater than the rate of inflation, which is good to see. And they are a dividend aristocrat with a 26-year dividend growth history, which is remarkable. And they actually do pay out their dividend monthly. So if you're looking for some monthly income, Realty Income Corp may be a nice addition to your portfolio. And with regard to dividend safety, they are ranked at a 70, so their dividend is still considered safe. So very unlikely that dividend gets cut anytime soon. Moving on to the last solid stock before we go into the speculative play, it is Berkshire Hathaway, ticker symbol BRK.B. So this is their Class B shares, currently at around $196 a share. 1-year chart, you can see they are down around 5%, and on the 52-week range, they are trading somewhat in the middle. So Berkshire Hathaway, when you were buying into this company, you were almost buying into an ETF. This company holds so many different brands under its umbrella, and it owns and operates companies that it owns 100% of, and it also owns large stakes in other big name companies. And currently, Berkshire Hathaway's 43% of their portfolio is within Apple stock, which is their largest holding. And Warren Buffett has been making some nice moves lately, buying more Bank of America, and he's also sitting on a massive stockpile of over $130 billion in cash. So this company continues to grow. They are a huge financial giant with so much cash on hand that they can make some big moves into the future, and I don't believe this company is going anywhere anytime soon. And of course, if you're looking for a nice growth play, they do not pay a dividend, but you can see here on the 10-year chart, they're up 150%. So you have some beautiful long-term share price appreciation with Berkshire Hathaway. They report earnings this week, of course, as well. Moving on to the final stock this week, this is the speculative stock that you may want to take a look at if you're interested in throwing your money into a little bit more of a high risk stock. It is Nikola Corporation, ticker symbol NKLA. Of course, this is the electric vehicle company that has actually not produced any vehicles just yet. Take a look on this 1 month chart. They saw a 55% decline in share price. On the 6 month chart, you can see the shares were very flat, huge share price appreciation, huge surge in share price when all the hype came around this company. Their 52-week high at around $94 a share. Now they're trading around $30. So they saw a massive decline from that all-time high, and they are continuing to downtrend over the past month or so. So this is a company, if you take a look at their website, they are going to produce electric vehicles, and they have a bunch of big rig electric vehicles, and of course this pickup truck. They have actually not produced any vehicles just yet. And in the electric vehicle sector, there are a bunch of competitors right now that are receiving a lot of hype and a lot of love from different investors. So Nikola is included in that list. This is one of the companies that you might have seen on the news and make big headlines. But if you're interested in the EV sector and you want to do your research into all the EV stocks and you think Nikola is the one for you, this week may see a nice buying opportunity because they are reporting their latest earnings as well. So thank you for tuning in, everyone. Those were the 8 stocks you should take a look at this week. Every single Sunday on this channel, we take a look at different stocks that report earnings and go over which stocks may be a nice buy for the upcoming week. So thank you for tuning in. I'm the Gen Z Investor, and I will see you in tomorrow's video.